Investment funds have become one of the most popular, if not the most popular vehicle for investors looking to invest for the long term. But what are exchange traded funds, mutual funds, and index funds? They all sound quite similar, and to some extent they are. But they have some key differences that make some of them amazing investments and others not quite as good. Let's break down what each of these are to understand the key similarities and differences, the benefits of each of them, which of the investments can give us the best return. And at the end of the video, I'll rank these investments from my least favorite investment to my most preferred investment. Before we get started, remember to smash the like button for the YouTube algorithm and click on the bell icon to be notified when my new videos are coming out. Let's get started. One glaring similarity between exchange-traded funds, mutual funds, and index funds are they're all investment funds. An investment fund is an investment vehicle where different investors pool their money into the investment vehicle for a specific purpose. For example, you could buy a particular fund, I could buy the same fund, Elon Musk could buy the same fund, and so could 1,000 other investors. And with all that money we've put into the fund provider would invest the money to meet a specific purpose. Remember the term specific purpose, as we're going to come back to it in some time. The benefit of a fund is that by pooling in everyone's money together, the fund provider can buy multiple different investments and then give each investor a portion of these investments. So for example, in an equity fund, the fund provider can use the fund's money to buy 100 different stocks and then give each investor a portion of these 100 stocks. And so instead of going and buying 100 stocks yourself, you can get instant diversification by buying a small amount of a fund. So ETFs, mutual funds, and index funds are all investment funds. And one of their key benefits is by buying them, you can get instant diversification even if you're just buying a small amount. Now, to understand the difference between these investments, let's first talk about ETFs and mutual funds, and you'll understand why later. I'll also be throwing out a lot of information, and this may be a little more detailed than other YouTube videos, so feel free to skip ahead where you find relevant. ETFs are exchange-traded funds. So as the term suggests, these are investment funds that you can buy on a stock exchange, just like you would buy shares of Apple, Amazon, or Tesla on a stock exchange. While mutual funds are not traded on a stock exchange. Instead, you can buy them through a brokerage by setting up a brokerage account, or through an intermediary like a bank that acts like a distributor of mutual funds. Because ETFs are exchange-traded, you can buy them throughout the day whenever the stock market is open. Mutual fund transactions, on the other hand, happen only once a day after the market closes. So even if you buy or sell a mutual fund before the market closes, the actual transaction only happens after the market closes. What this means is while ETFs are priced throughout the day when the stock market is open, mutual funds are priced only one time a day. If you check the mutual fund price before the market closes, its price reflects the value of the fund as of close of market the day before. And if you check the price of a mutual fund after the market closes, it reflects the value of the fund as of close of market on that day. Now, this can be seen as a pro or a con, because on one side, because you can buy or sell ETFs throughout the day, you have more flexibility to trade them and stare at their prices going up and down. But on the other hand, both mutual funds and ETFs are not really meant to be traded. Instead, they're meant to be long-term investments. So the fact that mutual funds are only priced once a day might actually be a good thing because it dissuades you from actively tracking and trading them. The amount you have to invest to buy an ETF depends on the share price of the ETF. For example, the SPDR S&P 500 ETF is currently around $390, which means to buy one share of the ETF, you would have to invest at least $390. But nowadays, more and more stock brokerages are allowing you to buy fractional shares, which means you could invest a smaller amount and just buy a fraction of the share. Most mutual funds also have a minimum investment amount. Although there are mutual funds with no minimums, most retail mutual funds do require a minimum investment amount of anywhere between $500 and $5,000. And you can find the minimum investment amount by going on the fund provider's website. ETFs also have tax advantages compared to mutual funds, and I won't go into that in this video because the video would get too long. But if you want to know more about that, you can check out my video on everything you need to know about ETFs. I'll link it in the description below. Lastly, if you want to check what investments your fund is actually holding, you can check their holdings report. ETFs publish their holdings report on a daily basis, while mutual funds publish their holdings report on a monthly or quarterly basis. And I would say those are the main differences between ETFs and mutual funds. Well, now that we've gone through what ETFs are and what mutual funds are, what are index funds? Well, this goes back to the definition of an investment fund. An investment fund is an investment vehicle where different investors pool their money into the investment vehicle for a specific purpose. Funds, whether they're exchange-traded funds or mutual funds, can have two types of specific purposes. They can be active funds or passive funds. A passive fund is a fund that tracks a market index, whether that be the S&P 500, the Nasdaq, or any other market index globally. The job of a passive fund is to replicate or copy the performance of the index it's tracking. For example, if the S&P 500 went up 10% last year, well, the job of a passive S&P 500 fund is to go up 10% as well. A passive fund doesn't try to beat the performance of the index it's tracking. It just tries to copy the index's performance, and most of them do this by buying exactly what the index holds. An active fund, on the other hand, takes a more hands-on approach. Active funds are run by fund managers, and the job of an active fund manager is to pick and choose investments with the aim of delivering a performance that beats the performance of an index. For example, if the S&P 500 went up 10% last year, well, the job of an active S&P 500 fund is to try to do better than 10%. Now, I'm not saying that they do this. In fact, most of them fail at doing this, but at least this is their objective. So in total, there are 4 different types of investments: active mutual funds, passive mutual funds, active ETFs, and passive ETFs. The term mutual fund in investing slang is used most commonly to describe an active mutual fund. But by definition, the term mutual fund actually encompasses both active and passive mutual funds. The term ETF is used most commonly to describe a passive ETF, and that's because most of the ETFs that exist today are passive ETFs. But by definition, the term ETF actually encompasses both passive and active ETFs. One popular active ETF you might have heard of is Cathie Wood's ARK ETF. The term index fund is used to describe a passive mutual fund or passive ETF because it's tracking an index. So just to avoid any confusion, a passive ETF like SPY, also known as the SPDR S&P 500 ETF Trust, is a type of index fund. And a passive mutual fund like VFIAX, also known as the Vanguard 500 Index Fund, is also a type of index fund. So the only difference in these 2 types of index funds is some of them are mutual funds and some of them are ETFs. So when it comes to active mutual funds, passive ETFs, and active ETFs, which one's the best? Just to add, before I start the list, I'm going to rank these investments based on which I think will help create the most wealth for you long term, and which investments offer the most flexibility for investors like us. In number 4 comes active mutual funds. Active mutual funds are run by multiple teams of investment specialists covering different sectors and asset classes. And though this may sound like a good thing, what this actually means is mutual funds are very expensive to run. Additionally, since they're more active in the market, buying and selling stocks more often, they rack up a high trading fees. The average expense ratio of an equity mutual fund is 0.5%, which might not seem like a lot, but this is more than 8 times higher than the average expense ratio of an index fund, which is just 0.06%. And since funds are long-term investments, the higher expense ratio really hampers the compound effect of performance, which is something that is essential for us. And this would all be okay if active mutual funds actually did their job of beating the index they were tracking. But based on multiple reports, over 90% of mutual funds have actually underperformed their benchmark over the last 20 years. Now, the expense ratio is not the only reason active mutual funds underperform, but it is one of the main reasons. And this also doesn't mean all active mutual funds are bad, but most of them are. I'll do a video solely focusing on mutual funds sometime in the future, so watch out for that. In number 3 comes active ETFs. Active ETFs have a similar drawback to active mutual funds. They're more expensive than their passive counterparts because they're run by multiple teams of investment specialists. For example, Cathie Wood's ARK ETF has an expense ratio of 0.75%. But most actively managed ETFs have expense ratios that are lower than active mutual funds that provide an investor with exposure to a similar strategy. This is because operationally, ETFs are cheaper to run than mutual funds. They're also better than mutual funds for the reasons I highlighted earlier on in this video. You can buy or sell them throughout the day when the stock market is open. They have a live price throughout the day. They're more transparent because they publish a daily holdings report, and they have tax advantages. So when I pursue an active strategy through funds, I almost always buy active ETFs over mutual funds. Now, there's a marginal difference between 1 and 2 on the list. Some investors prefer to buy passive mutual funds and some prefer passive ETFs. And honestly, both of them are amazing investments. Me personally, I would put passive mutual funds in number 2. Passive mutual funds are extremely cheap. They provide you with a lot of diversification. They dissuade you from active management because you can only trade them 1 time a day. And so they're amazing investments. The only reason I put them in number 2 is because some of them do have a high minimum investment amount. For example, the Vanguard 500 Index Fund, which tracks the S&P 500 index and is one of the most popular passive mutual funds, has a minimum investment amount of $3,000. Additionally, I prefer the flexibility of being able to buy or sell any investment I have throughout the day and not having to wait until the market closes before I know what price I'm getting. And so that's why my favorite investment out of these is passive ETFs, because they're cheap, transparent, flexible, and have tax benefits. Additionally, in markets where the economy is most developed, like the US and the UK, you have a large variety of passive ETFs you can choose from that track pretty much any index. I hope you found this video useful. If you did, do smash the like button. Check out my video on the top 5 ETFs to buy in 2022 and top 5 dividend ETFs to buy in 2022. I'll see you in the next one.